The other tool that can be used that sort of relates to the executive branch to combat like financial problems is called monetary policy. Now, monetary policy doesn't involve the president or Congress as much, and it involves sort of another group that sort of has ties to the executive branch. The Federal Reserve is most responsible for conducting the nation's monetary policy. The Federal Reserve is sort of like the main sort of financial institution that oversees like all of the sort of banking in this country. Think of it as like the bank for the banks. And it really uses its control over the money supply in this country to fix like some of the economic problems, either inflation or deflation that may be occurring at the time. The Federal Reserve is made up of 7 people. It's called a Board of Governors, and they each serve 14-year terms. So they're guaranteed to overlap presidents. And you get to be on the Federal Reserve. They're staggered terms, so it's not like everybody's up at the same time. You get to be on the Federal Reserve Board of Governors by being appointed by the president. Likewise, the chairperson of the Federal Reserve, who's also appointed by the president, serves a 4-year term. And this person is often seen as being sort of like one of the chief economic advisors for the country. So again, the Federal Reserve, think of it as almost like the bank for all of the regular banks in your sort of neighborhood. So what can the Fed do? What can the Federal Reserve do? One of the things that it can do is it can manipulate what's called the reserve requirement. This is the amount of money that the Federal Reserve makes your local bank sort of keep within their vaults, like keep on premises. This is the money that your bank must have in its vault. So, what is the significance of either raising or lowering the reserve requirement? If you raise the reserve requirement, you essentially are forcing banks to keep more money in like their vaults, in their on hand, which means if they have to keep more back, they're not going to be able to lend as much out to citizens, which means this is going to cut down on spending, and this is going to combat like large periods of inflation where prices are going up because people are spending so much. The Federal Reserve just raises the reserve requirement. It cuts back on how much banks can lend out. It reduces spending, and that sort of fights against inflation. Or the Federal Reserve could lower the reserve requirements. This basically means that banks have to keep less back. The amount that they have to have on hand is less. So banks are free to lend more of their money out, which essentially could increase spending, and this could combat periods of deflation because banks are able to lend more. Theoretically, the citizens then that can borrow more from banks will be able to spend more, and this spending, increased spending, will combat inflation. So this is one of the tools the Federal Reserve has to deal with periods of inflation and deflation, and that's to raise the reserve requirement or to lower the reserve requirement. The other major thing that the Fed can do is manipulate what's called the discount rate. This is the rate at which the Federal Reserve loans money to your local banks. So like where does your bank get money from? It can actually borrow money from this like master bank, which is the Federal Reserve. So this is the rate again at which your local bank borrows money from the Fed. If the Federal Reserve raises the discount rate, this essentially means that it'll cost banks more to sort of borrow money from the Federal Reserve. In exchange, they have to pass along those increased costs to regular citizens that are coming into their bank to borrow money. So this would cause banks to raise interest rates, which is the rate at which you loan money to individuals. Obviously, if you borrow $10,000 from your bank to buy a car, you're not sort of just paying back $10,000. You're going to pay back $10,000 plus then a determined interest rate, which is extra money just for the right to borrow the money. So again, if the Federal Reserve raises the discount rate, that's costing your local bank more to borrow from the Fed, which means they have to pass that along to you when you borrow money in the form of a higher interest rate, right? This means probably that less people are going to be willing to go into a bank and borrow money because it's going to cost more to pay back. So this would help sort of like fight against inflation and this period of like intense spending by consumers. This would cause less loans to be given out. Citizens will have less money as a result, and that'll cut down on the spending and cut down on the inflation. Or the Fed could lower the discount rate. That means it's going to be cheaper for your bank to borrow money from the Fed, which means then that they can pass along those savings to you. Again, the rate at which they loan you money is called an interest rate. And when it's costing them less to borrow from the Fed, it's going to in turn cost you less to borrow from the bank. So this means that if the Federal Reserve lowers the discount rate, that allows your local bank in turn to lower the interest rate, which means now all of a sudden, maybe if you were thinking about getting a new house or a new car, because the interest rates are lower and you'll have to pay back less money to the bank, you might be willing to take out that loan now. And this would increase spending, and this would sort of combat periods of deflation where you're seeing like less spending overall. So again, sort of the reserve requirement and the discount rate are two tools that can be manipulated by the Federal Reserve to either increase or decrease spending from regular citizens.